The TTF sentiment benchmark shows a strong bullish preference. The charts are set up for a bounce, and our proprietary indicators have been signaling a move higher. All that is missing now is an actual push past the bullish trigger level. And until that happens, unfortunately, we really have to sit this one out. Hello, everyone. My name is Marcello Colax. I'm the managing director at Clever Markets, and today I'm walking you through the European energy charts for the week starting 15th of December 2025. And this also is the last Monday update until the start of next year, because I'm sure a lot of you are already settling into hibernation mode. So let's have a look what the sentiment is telling us. You can see that last week we still had a good split of bullish and bearish traders with almost being equally represented. But we can see that at the start of this week, with around 165 respondents, we see that the bulls are taking over. The bulls are represented with 54%, whereas the bears are represented with 25%. Just over 20% have no strong opinion or think that the market is gonna go sideways. And this morning we have updated the front page of our dashboard the following. So we see that the TTF and the NBP are ready to move higher. We moved from bearishness a couple of days ago towards neutrality on the hourly chart, which is usually showing that the market is bottoming out within the underlying downtrend, right? This is super important. Now we understand that after the downtrend, we are bottoming out. So there is a chance for the market to push higher, but of course there is no confirmation yet. This has already happened on the TTF front season, where we immediately switched towards a bullishness, and you also see that the German power market is already bullish, as is the EUAs. EUAs is super interesting. Let's talk about that in a second, but we are not entirely sure how far the bulls can actually continue, because what we are seeing here is not a forecast state or prediction. That is simply showing us what the market is currently doing, and the EUAs are looking pretty toppy to us. So let's get started with the TTF front month. So what we're seeing here, zoomed out on the weekly chart, is that a couple of weeks ago, the bears finally, or someone at least, finally made a call, and we broke out of the sideways range that goes back all the way towards mid-August or even a little bit before that. You can see we did break below this range, and now we had a couple of weeks of continuous losses. Last week ended with a small green candle, simply showing us that the bears are a little bit exhausted. Now the next question is, like, how much lower can it go? Is that a correction? Is it a full-on trend reversal? So for that, I am looking at the MACD, the moving average convergence divergence, and I noticed that a couple of weeks ago we did get a bearish, no wait, 2 weeks ago, we did get a bearish crossover where the MACD moves below its signal line. So this is overall bearish. Then we are zooming out again, and we start looking at the 8 and 12 exponential moving averages, and they are still both pointing down. The 8 and 12 is just our personal choice. You can go with the 20, with the 50, they're all good, but they're all showing us that they are pointing lower, which means the bears are in charge for now. Then I always keep an eye on the stochastic, because the stochastic would tell us if the market is more likely to bounce or not. So you can see, in the grand scheme of things, even if we believe that there is a chance for a bounce, in the big picture, the bears are still in control on the weekly chart, because we would only get a bullish signal above 20 if we move above the oversold territory. Didn't happen yet. We did get a preliminary bullish signal with %K crossing above %D, so the white line crossing above the orange line, but this is not a strong bullish signal whatsoever. We really want to wait until 20 breaks. Not happening right now. And you can see our first resistance level is still very, very far away. It is at 33.91. So anything, even a smaller correction, might be best traded on the lower level charts, probably with Fibonacci retracement levels. Now, let's have a look at the TTF front month daily chart. Just as a little reminder, I'm sure you all still remember, we had the sideways range, right? And this was marked out by this descending triangle, where the market was making lower peaks, whereas the support remained the same. So this descending triangle is showing us that the market was willing to buy at lower and lower prices, while the support remained the same, which increases bearish pressure. And this bearish pressure took over in late November, with the bears continuing. So you can see last week we had quite a bit of a sideways range. And this was not unexpected. So, as you know, if you're a client already, you know that we were looking for the market to bottom out. So, all of this made a lot of sense. We started having an exchange of green and red candles, one after another, every candle having a long body or at least a long wick, with the market like testing out a direction. So it all started with these two candles here. This here, I mean, it's not quite a spinning top, it's not quite a dragonfly doji or long-legged doji, but it is showing us that the bears tried to push lower, failed, and then simply ended up where they started. The next candle is an inverted hammer where the bulls tried to push higher for the first time in a long, long time. They couldn't quite make it, but it is a sign that the preceding downtrend could slowly come to an end. And then we had like a number of bullish and bearish candles. And the interesting thing is, we are marking out the upper end of this inverted hammer, which is at 27.8. We did put on the Fibonacci retracement levels with the 0 down here at 26.54 and the 100 up here at 31.96. We can see that the 23.6% Fib retracement is also the 27.8, which is the same as the inverted hammer trigger level. And we can see it also coincides with the 12 exponential moving average. So if we have many traders with many different trading strategies all looking at the same level, that means if it is broken, a lot of traders will be right and a lot of traders will be wrong. So that means that a move might happen quite fast if we push higher. Doesn't mean the move is more likely to happen or less likely to happen. It just means whatever happens, happens probably quite fast. But you can see for us, we are still thinking that the sideways range is maintained for a little bit, or not the sideways range, but the market is bottoming out. We are forming a base within 26.54, 27.8. This is what we are looking at. Now, the next question is this more likely to be a correction or a reversal? Let's have a look. So we are looking at the MACD, and we can see that the indicator has been pushing lower while the price was also moving lower in the preceding downtrend. So the bears were aligned, the bears were strong. This is showing me that whatever happens now, an extended sideways range, an eventual push higher, maybe even a corrective move towards 28.61, which is the 38.2% Fib retracement, or even a move up towards 30, which is a round number. It's the gap, it's the descending triangle pullback resistance. It's the 61.8% Fib retracement. The market could extend until here, but whatever happens, this here is still most likely to be a corrective move in an underlying uptrend, at least for now, because the bears were still strong. So this here is just a profit taking opportunity before the bears continue, most likely. So at what point do we know that this is not just a correction? Well, if we start seeing that the MACD starts pushing higher significantly, maybe even above its zero line, if we are approaching the 30 level, but on the hourly chart, we are still seeing really strong trend and momentum tools. And there is a good chance that we break above this range, 30, 30.3, then I would say that this is more likely to be a full-on bullish reversal. Doesn't mean we have to wait for, what is this, 27.8 until 30 before we make a bullish move. No, no, no. Of course, we can trade this up leg on the hourly chart first. So when do we know that the bears are in charge? Well, we know that the bears will simply continue if the sideways range is resolved to the downside with 26.54. Now, what I just walked us through was a few concepts. We included distinguishing between corrections and reversals with indicators. We talked about multi-time frame analysis and how to trade the counter legs. We covered Fibonacci retracement levels. We identified key support and resistance levels. And we are not just working with saying that the market is bullish or bearish. We are actually building scenarios as part of our methodology. So if you're interested in doing this yourself, then talk to me this week before we all go into the winter break. Next March 2026, the Clever Markets Technical Analysis Academy will start its next cohort where we are not just giving you the tools to build your own methodology, but we'll show you how to combine them into a working system alongside your existing fundamental models. Send me a DM on LinkedIn or simply go to our website for contact details. Now let's have a look at the hourly chart. So the exchange of red and green candles stacked one after another on the daily chart is expressed as a rectangle range on the hourly chart. You can see here once again 26.54, 27.8, exactly the same, right? And we can see that the bulls and the bears are swinging within this range. And that interrupted the preceding descending channel that we had here with the market slowly moving into the sideways range. Remember what we said about the MACD being in alignment with the market? Let's look at this. The market was still moving down here in this clearly defined channel a couple of days ago, while the MACD was making higher highs and higher lows, right? The troughs were getting higher. Here, the highs were getting a little bit higher. So the bearish momentum was slowly deteriorating. So the bears were running out of steam. So that's why we were so confident about the market breaking sideways sometime soon. Now, what happens next? We can see that the MACD made a distinct break above the zero line, which is a bullish signal. We got a bullish golden cross on the 8 and 12 exponential moving averages. A golden cross simply means that both moving averages are already rising. And we see that the shorter 8 moving average pushes above the longer 12 moving average, showing that the bulls are already in play, but now even stronger than before. So all of this is looking a little bit bullish to us. Then, of course, you remember I am looking at the stochastic to scan for any bearish signals. So what do we see here? We are still in overbought territory, which is bullish, by the way. This is not bearish. I know it's called overbought, which implies that something has happened too much. We are buying too much overbought, but this is not the case. It simply means we got a trend going on, or at least a little bit of the resemblance of a trend. Yes, we did get a bearish crossover within overbought territory, so that is potentially a bearish setup. But just being in the extreme territory is not a setup. So we would only get a bearish signal below 80. I think there's nothing crazy, so maybe we get a little bit of a sideways move, maybe a tiny move lower, but ultimately the bulls should still prevail on the hourly chart, which would then trigger the uptrend or the up leg on the daily chart that we just talked about here. But once again, we really must wait for a move above 27.8 before we start having a strong opinion on the market again. Now let's have a look at the German power front here, because here the story looks a little bit different. So we'll start once again on the weekly chart. Remember, it's always important to zoom out to get a picture to get a big picture, right? So we have been working with this Head and Shoulders pattern for quite some time. It goes back to July 2024. And the Head and Shoulders pattern is usually showing us that the bulls are exhausted. After the latest high, we start forming a first lower peak, which is the right shoulder, right? So these are the two shoulders, this is the head, and this down here is called the neckline. And we would only get a firm bearish signal below the neckline, and in our case, that is the 80 level. Hasn't happened for quite some time. So let's zoom in. Let's do the alternative case first. The whole idea of this being a head and shoulders, or right now it is a complex head and shoulders because the right shoulder has been in play for such a long time. The whole idea of the market eventually breaking lower would be invalidated above 90.93 or 94. Depends on how you see it, but then we would no longer be making lower lows and lower highs, and this wouldn't be a shoulder anymore. The Bears would be fully in charge below 80. Now, whether or not you think either of these levels is more likely to break doesn't really matter. We can't predict the future, but we can still trade with what the market is doing today. So all of the trading decisions we are deriving are best identified on the daily and hourly chart. But for now, let's have a look. This here almost looks like a hammer candle. I know by definition it doesn't because the lower wick isn't long enough, but we do get the idea that the bears tried to push lower, they kind of failed, which can be a sign of bearish exhaustion after just 1, 2, 3 red candles. Why do we still think that the market is more likely to move down? Because this tentative bullish candle pattern was not confirmed with trend and momentum tools. You can see that we still have the MACD moving lower. We are even pushing below the zero line, which is a strong bearish signal. And we are also not getting a bullish signal from the stochastic. We can see with the stochastic still reasonably pointing lower. And we are also seeing that, we shouldn't really use the moving averages in a sideways range, but you can see that they're tilting down a little bit, but this is not a strong signal to be taken anyway. So that is why we still think that 80 at least is the more likely target for now. So let's have a look at the daily chart to actually make this tradable. Have a look at this. We have been working with an ascending channel for some time. It wasn't always perfect and we did get our occasional breaks lower, but overall it did hold quite firmly. We have now broken below this a couple of weeks ago and we have bottomed out. So what's the first thing that we do if we see that the market is bottoming out? We put in Fibonacci retracement levels to simply assess how far the price can go. So let's have a look. We put a 0 down here at the 82.7 and we put the 100 up here at the 90.48. And you can see we are a little bit more advanced than on the TTF. Here we already broke above the 23.6% Fib retracement at 84.49, which was here. So anything below that is just considered noise. The market might hover sideways as we have seen it on the TTF. Here we already broke above it. So what's the next target? 85.68, which is the 38.2% Fib retracement. If we push above this, and now we are talking about the alternative case first, then we could make it towards the 86.8 area. This is not clearly defined, but you can see here, this is the tiny gap. It's the 200-day exponential moving average. It's the channel pullback resistance. So it's all coming together here. It's also not too far away from the 87.48, which is the 61.8% Fib retracement. So this whole area here, good resistance if we even make it towards that or past that. Doesn't seem all that likely. What seems more likely is eventual downside continuation. But you can see here, we are not going like full on bearish immediately. We are still just pointing towards the 82.7 support can be tested. So for now, it's too early to say like if we will push below that or not. So what do? Well, this whole thing here is best traded on the hourly chart. On the hourly chart this morning, we'll keep an eye on whether or not the 85.68 is more likely to hold or not, simply by looking on the hourly chart and seeing if the flow of higher highs and higher lows is maintained or not. We'll also look at trend and momentum tools to see if they continue to point higher, which would make scenario 2 the more likely scenario then. If, however, we start seeing that the market starts moving sideways, maybe the up legs are getting shorter and shorter, maybe the momentum isn't as high anymore and we start seeing some divergence, then the preferred case of the market pointing down might play out. So of course we can trade this down leg then on the hourly chart, which would be a super early and convenient starting point if the market was to push lower, right? Then we probably got in somewhere here already. Super nice. So what do? Let's have a look at the hourly chart. Here you can see the picture looks different to the TTF. On the TTF, we started an extended sideways range. We had the idea of a sideways range here, but it wasn't all that nice, and we had more of a triangle, if at all. We pushed higher, the bulls are in charge. We are well above the zero line on the MACD. Are we getting a bearish signal yet on the stochastic? Oh yeah, look at this. We did get a bearish stochastic signal. So what does that mean? So that means that we might push a little bit sideways, maybe a little bit down, but ultimately you can see our preferred scenario is still scenario 1. Why is that? Remember the interplay between the MACD and the oscillators? Because the MACD is still bullish, the oscillator is just giving us a corrective signal, not a full-on reversal signal. And you can see the first important resistance to be taken is the 85.8. Of course, if you're neutral, have an entry point at 85.36. This is not trading advice. This is just best practices if we know that the flow of higher highs and higher lows is continued. So when do we know that the bulls are not pulling through? Well, if we get an hourly close below 84.74, if we get like two red candles past this point, then we might retrace lower towards 83.46, and then maybe we start forming an extended sideways range. What happens after that, we simply need to see when it happens in the following sessions. So let's have a look at the EUAs next. What is going on? So the bull trend has been in place for quite some time. The MACD is bullish, no bearish indications on the stochastic. The moving averages are pointing higher, yet we still think that the market will go down at least a little bit. Why is that? That's because what's shown on the daily chart. The bulls haven't really pushed through for quite a couple of weeks. So what might turn out to be a significant down leg on the daily chart might still just be a corrective move on the weekly chart. So keep that in mind. So what's happening on the daily chart here? So we are working with a rising wedge, and the rising wedge coupled with the declining MACD is showing us that the bulls are still in charge. So we're not taking a trading decision off of that, but it is showing us that the bulls are running out of steam. So this is a very important distinction. Just because we see that the bulls are slowly being exhausted doesn't mean the market is bearish and we start looking for short selling opportunities. Absolutely not. The market can still go higher for a significant amount of time. And as we have seen, this can happen for months and months and months. It is simply showing us that the up legs are getting shorter and we have to be more careful with our bullish views. So you can see right now we only have like one big green candle, a second one, and we correct lower. 2, 3 green candles and we move lower, sideways trend. 1, 2 green candles and we are already going sideways again. So these moves are best traded, if at all, on the hourly and 15-minute chart. But we are not trying to enter short, enter short, enter short. Absolutely not, because the bull trend is still in place. It is just getting weaker with every swing. So practically speaking, what do we do? First things first, we don't go short on the daily chart. Step 2, trading opportunities are getting smaller and smaller, so they're best traded on the hourly and 15-minute chart. Then we could consider reducing our long position if we still have one open from when the uptrend began. We are also not super interested in some really big conviction bull trades right now. Here we really just have to take it one swing at a time. So when do we know that the uptrend is actually coming to an end? Well, below 81.22, because it is the most recent trough and is kind of near the rising wedge support as well. And it's also where the 12 exponential moving average is. Only below that level could we say with greater certainty that the downtrend is firming up. Alternatively, the market could push higher, which would reinvigorate the bulls. We might make it towards 87.28, but this is not a strong preference right now. It is really just the alternative, especially with the momentum tools pointing lower. Now, let's have a look at the hourly chart. Here we are working with a rising wedge within an ascending channel, and that is very telling, right? Once again, an ascending channel is showing us that the bulls are in charge, or they have been in charge for quite some time, and then the rising wedge within it is showing us that the uptrend or the up legs are getting shorter and shorter, so the bulls are not really all that convinced anymore. What we saw more recently is this false break. And yes, I do think it is a false break. And you can see we don't expect the market to move much higher, if at all. And that's simply because the move higher happened on low volume. We're now also dealing with the contract switch, which happens in December for the EUAs. And we also see that the trend and momentum tools are pointing down. So I kind of want to see how the new contract stitches onto this one here, how the trend can or will be continued. But overall, for now, it looks rather bearish to us. But please do keep the contract change in mind. And that is all for today. I hope you found this insightful. If you want to learn more, go to clevermarkets.com, where we help institutional energy traders embed systematic trading systems into their fundamental workflow. Step 1 is the Academy in March. Everyone, have a good start into the last week. Have a good start into the week. I hope you're all getting into the Christmas spirit. See you around and bye-bye.